Welcome, ladies and gentlemen. The next session is Decoding Algos 101. We are delighted to have our esteemed speakers. Please welcome them with a big round of applause. Mr. Sanjay Rawal, CEO, Open Futures Group, and Mr. Rajib Ranjan Borah, CEO and co-founder, iRage. Give them a big round of applause, ladies and gentlemen. Over to you.
Okay, so can I get the device to change this? Yeah. So basically, welcome everyone. Thanks a lot for taking your time. So both of us have been in the industry. I don't know since how long you have been in the industry. We just completed 16 years a few days back. So I'll start with the very first question. Next slide, please. So can you define how you got into the industry, what your first reality check was, the shock that you got when you got into this industry? I believe you come from a traditional trading background as well, so the manual pace. So yeah, first question to you.
So thank you all for attending in such large numbers. Essentially, I got into trading purely by default, in the sense that I decided one day to go to the floor of the exchange when there used to be a floor, which was probably, I don't see anybody who's probably seen a floor. Yeah, so I basically got super interested because I just went on the floor and I loved that enthusiasm and that energy on the floor, and the fact that you could make money using effectively maths. And that to me was the biggest sort of turning point, whether it was in traditional trading or whether it was in algo trading. Because algo trading itself, in many ways, and Rajiv will bear me out, involves, you need to have the discipline and the ability to look at a price or at a situation very, very mathematically too, right? So I think to me that was the biggest sort of good thing about algo trading. The most shocking thing about algo trading, to me at least, was the fact that so few people actually believed in it 10, 20 years ago. And it's only in the last probably, Rajiv also is probably among the pioneers in the newer wave of people who believed in algo trading. So yeah, that's how it started for me, and that's how I went about it. So maybe you can answer the next one, which is that when people hear about algorithmic trading, they often think of it as if it's some small corner of the market or whatever. But according to you, what is the kind of scale that we're talking about? I mean, maybe to the audience, if we can talk a bit about what does it mean when you're doing a trade, as to how much an algorithm is involved in that trade?
Okay, that's a very nice question. So it's almost like looking at an iceberg and trying to guess what is the size of the iceberg beneath the water, right? So there are various estimates as to what is the total volume on the exchanges that might be done via algorithms. It could be the logic and then the order. The signals could be generated by algorithms, but then the execution could be manual. The logic as well as the execution could be algorithmic. So where everything end-to-end is algorithmic, the best case guess is that around 70% of equity volumes globally is through algorithms. And not just that, you might wonder what is the scale at which firms like us operate, the way we operate. So what do we need to do? So at our firm, it's not today, like 3.5 years back, 4 of our top tech guys spent 2 full days sitting inside a room and then discussing how to reduce 1 clock cycle. That's it. And then this was because they were coding in hardware. So we were just trying to reduce 6.5 nanoseconds, 3.3 into 2, 6.6 nanoseconds. 2 full days just discussing how to do that. Other questions that you might have is, I want to get into algorithmic trading. What is the scale involved? So the amount of data that you get from the exchanges on a daily basis is in terms of terabytes. So every day you are solving a big data problem. You are solving a big billion day problem every day. So I personally feel that if you have a passion for numbers, if you have a passion for programming, this industry has some of the most wonderful scale problems to solve. So talking of scale, we also need to define the breadth that algorithmic trading has. Do you want to discuss that?
So when you talk about breadth, what are you referring to?
So what is algorithmic trading? So for example, you can go to a McDonald's and then you can get food. You can also go to the Indian accent here where you get Michelin grade food. So likewise, algorithmic trading has a diversity.
Right.
You have, yeah, so.
So I think what Rajiv is trying to come around to asking and trying to get you all to think about is a bit more about what is the scope of algorithmic trading, what kind of things can you do with algorithms, right? And the broad answer is virtually unlimited, right? So the reality remains that the reason why algorithms work, whether Google uses it or OpenAI uses it or our companies use it, any form of algorithm, essentially is because their scope and scale is massive, right? Within the trading space, you can use algos for multiple reasons. I mean, multiple things. Should we just talk a bit more about types of these things over here, or would you prefer to do something else?
I think in a subsequent slide, we have the different types of strategies. Probably we
So
can
we'll
touch
come
upon that
there,
later. So basically, algo trading is not just restricted to firms. It's a broad scope. Even a retail, smart retail, using Python, that is also algorithmic trading. Firms like us deploying hundreds of servers at co-location, figuring out how to reduce just 3.3 nanosecond, that is also algo trading. So therefore, regulators, when they try to build regulations for algo trading, for example, they have to think of the entire scope, and that is where their challenges and complexities are.
I think, Rajiv, maybe what would be a good idea for our audience is to try to talk a bit more about market microstructure. What does that mean, and where can we take it from there, right? So this is great. So maybe you can talk about this a bit more, and I can talk a bit more about the backtesting framework or something.
Okay, okay, good. So basically, I see a lot of young faces. Very soon, most of you would buy a house, or many of you would already have a house. The first thing that you need to know is how is the waterproofing done, how is the plumbing done. So if plumbing is not done properly, no matter how good an interior decoration you do, you are going to have problems with your house. Likewise, in the markets, you need to understand the market microstructure. So basically, when you get into algorithmic trading, so you need to know the way you can decipher information from the exchange, the information that comes from the exchange. So it's very important to understand how to interpret the different types of orders from the market data stream that comes from the exchange. So basically, the exchange publishes information democratically and secularly to everyone. Everyone gets the market data. Now, from the market data, you need to figure out, hey, what are different types of participants trying to do? So therefore, you need to figure out if under what conditions people send out, behave in a certain way, and under what conditions people behave in some other way. So the most important thing is to actually understand what is an order book. So an order book is basically a set of ask prices and a set of bid prices, right? These are the buyers, these are the sellers. The best seller is at 100.70, so there is no one willing to sell lower than this. The best buyer is at 100.05, no one is willing to buy higher than this. Now, within this, there is a lot of, the entire magic is within this. So for example, you see that there is a really big seller here, 80,000 quantity, and then the buyers, the quantity is much lesser. So therefore, you would guess that probably the prices would go down. Now say if you are building a trading strategy, so you need to figure out if I put a buy order at 100.10, what is the likelihood of it getting traded? If I put my buy order at 100.65, what is the likelihood of it getting traded? If instead of the prices being very close together, if on the sale side, these were like really spread out, then what is the likelihood of my order getting traded? So historically, because programming and technologies were not as evolved. So computing was not evolved. The concepts were always there. So therefore, people used to just look at very minute number of data points, which is end of day data points or end of minute, end of second data points to build trading strategies. But then with advances in computing and with advances in data sciences, people can now look at information at a much more deeper level. So therefore, just by looking at the rate at which market orders or limit orders or IOC orders are entering or exiting the order book, you can build much more sophisticated and intelligent strategies, because the cost of sending an order at the exchange is very high. You need to put up servers, you need to pay to the exchange to get message lines to send orders. These message lines are very expensive. My friends at MCX might not agree, but then these are expensive. Everything is expensive. User IDs.
I would agree.
So everything is expensive, so people do not send out orders for fun. People send out orders because they have a pressing need to buy or sell. So therefore, traditionally, trading strategies were made just by looking at the end-of-day prices. Then people started looking at end-of-minute prices or list of traded prices. But if you look at the list of the entire order book, it's like, okay, anyone wants to guess what is the ratio of number of orders sent to the exchange to the number of trades that happen on the exchanges? Any wild guesses? So
take a random number. Somebody. Say that again. 5:1, okay. Next. Be a little more ambitious.
20:1, 5% is what she said, okay. So the real number would be in the zone of 1,000:1. And then because people don't send out orders for fun, because if you send orders for fun, the regulators are going to catch you, the surveillance at the exchange is going to catch you, and then it's expensive. So people send out buy and sell orders because they have a pressing need to buy or sell. So therefore, using order information gives you 1,000 times more intelligence than just looking at trade prices, which traditionally people had been doing. And therefore, this becomes the foundation. So being able to comprehend market microstructure, how to make sense of information entering and exiting the order book, that becomes key. Yeah, next slide. So yeah, you can talk about backtesting and so on.
Actually, go back to the. Can you just go back to this one?
Previous slide.
So there's an interesting point in this slide. I wonder if, since Rajiv spoke about this 80,000, can anybody guess what that interesting thought might be about this 80,000? And it relates to time. Can anybody sort of think about it? I'll make it easier this time around, but I think this is how you should think. Yeah, go ahead.
They might think to reduce the price further just to get the news.
That too, yes. But the more important point is to ask, how long was this 80,000 there? So supposing this guy was sitting there since the morning, you can rely on this order a lot more, right? You should give it a lot more weightage. This is it's a feature that a lot of us will use in some form or the other. But effectively what it means is that an order which is very, very fleeting has less value, right? And so again, going back to what Rajiv was trying to point out, right? Because of advances in both statistical understanding, data sciences, and the amount of compute we can all get at a reasonable price, we are all able to discern things like this and sort of research those things much easier than we used to be able to do it, let's say, 10 years ago, right? So all of that has helped us in expanding from there. So maybe now we can move forward. Yeah. Go ahead.
How will I know when that was played? You said since morning it is.
Yeah, so this is a good part of at least the Indian exchanges. Indian exchanges, in some senses, you are actually blessed in some senses that Indian exchanges actually give you a lot more information in the market data feed compared to most international exchanges. In that sense, NSE is like the torchbearer of giving you granular information, which is unprecedented. It's very difficult to get that kind of granularity. Even MCX, for that matter, does have very granular data. Of course, there are differences in the way their data is published, BSE's data is published, or NSE's data is published. But Indian exchanges, by and large, have very, very granular data, and so you know what the time was when this order was placed. In any case, Indian exchanges and pretty much all exchanges worldwide follow only one principle, which is price time priority. So somebody's price is higher, he gets priority on this thing. somebody's time is before you, and you're at the same price, he gets priority.
So to add on to your question, so basically, if you so on the exchanges you get something known as tick by tick data. So you get each and every order placed on the exchange the moment someone placed it. So you could listen to market data in various formats. So different exchanges, some exchanges give snapshot, and tick by tick. Snapshot is a snapshot of the top n buyers and sellers every second. And then you can listen to tick by tick, wherein you get each and every order the moment it is placed. So now, when you recorded a tick, you know when it was placed. But the amount of data in tick by tick is huge. So therefore, some exchanges have different solutions wherein they say that, okay, we will give you a snapshot every time something within the top n changes and so on. So there are permutation combinations, but then if you listen to tick by tick, you get that answer. Staying on market microstructure. So because you have been seen the industry pre-algo and then now, so how do you think the market microstructure has changed because of the huge flurry of algo trading activity now?
Oh, enormously. I think essentially, you sort of alluded to that change by way of talking about the number of orders, right? So if the number of orders that are going to get filled is 1 is to 1,000, 1 is to 5,000, whatever be that number based on the exchange, why is that the case? If when you were on the floor, an order was what? Where I shouted out an order and said, I want to buy, let's say, Tata Steel. But that was the order, right? That was the single order that I was shouting out. So I could not shout out 1 million orders in a day, right? Today, one server of mine can send out 1 million orders, right? So logically, what's happened is that the microstructure has become so granular, but has got so much noise in there that for somebody who's a geek and really understands numbers and likes murder mysteries, let's say, then for him it's a fantastic place to be, because you're actually trying to find clues in figuring out what is that microstructure doing and telling you, and what can you discern out of that. So it's very much, so I don't know how many of you so I love murder mysteries, and a lot of my analogies, even inside my companies, is by way of movies and books and things like that. And so it's very much a Agatha Christie novel, and you're doing that for pretty much every single take. So it's mind-bending in some ways, because when you start thinking of it like this, that where's that clue? Who's the murderer here? Who's the good guy here? And suddenly, when you start putting it in that context, it becomes very interesting.
So, and then adding on to Sanjay ji's answer, so I personally, the way I see it is earlier. So a lot of us like to paint the high frequency trading guys and then the algo guys as the evil guys. But let me put my perspective. So earlier, if you wanted to buy a share whose fair price was around 1,000, the bid ask in the market would be say 980 at 1,020. So you would end up paying 20 rupees of extra premium to the broker, the manual trader on the pit. Nowadays, because technology has enabled firms to adapt to events very quickly. So the moment I see a price, some event price changes in Nifty, I can modify my quotes in Reliance immediately. So therefore, it has enabled me to quote really tighter. So today I can say that I am willing to buy at 999.90 and sell at 1,000.10. So the effective spread that the end user pays is only 10 paisa rather than 20 rupees historically. So there is an enormous tightening of spreads that we have seen. It has happened all throughout the lifetime of our firm, but then it has accelerated in the last 5 years after the increase in volumes on the Indian exchanges. The bid-ask spreads on all exchanges, NSE, BSE, MCX, everywhere, has tightened dramatically, which has improved liquidity, given the confidence to people to invest in financial markets, and then investors to invest in pre-IPO companies because they know that they will find the proper valuation on the exchanges and liquidity to move out. Yeah, sorry.
So can anybody tell me if what we have written over there with the gross returns, whether there's something wrong with that equation? There is something wrong with that equation, by the way. So this is actually the net returns, right? Because we've reduced the transaction cost. And so I think the point that Rajiv was making just now, and to buttress his point about the liquidity now having tightened so much, right? It has allowed the transaction cost to become a massive variable in the way we look at prices and the way we try to predict prices and the way we try to trade. Unlike earlier, where you were basically trying to get just alpha and trying to say, if I buy at 100, I'm going to try to sell at 105, because transaction cost in that did not matter beyond a point. But because of what high frequency players and algorithmic players have ended up doing, which is compressing the market enormously. So what that has led to is a tightening of spread and therefore a massive increase in transaction cost, right? So transaction cost constitutes something that has become, we actually have models for trying to figure out how do you reduce transaction cost. Are you willing to lose some more money because the transaction cost is higher? How do you think of transaction cost? How much do you want to expand your range of losses that you're willing to give, because otherwise if you ended up doing 5 more trades, what would happen, and things like that. I'm sure both of our firms do exactly that same kind of analysis. But the broad point we are trying to make to you is that when you look at any strategy, you start with the same basics, right? You try to figure out, does my strategy make money? What is the risk in the strategy? And that's the Sharpe ratio is somewhat of a metric for that. There are various metrics you use, but Sharpe is essentially, whenever you talk to a fund manager, to a portfolio manager or a HFT trader or a hedge fund trader, whatever, Sharpe is generally mentioned, right? So it will certainly come up there. The capacity constraints that we're talking about is because there are kinds of strategies which you cannot scale beyond a point. They may be very profitable, but they're profitable for if you continue doing 5,000 rupees worth of trade the whole day. Keep buying, selling 5,000 rupees. You try to do 50,000 and you do it continuously, then it has a major problem. So it's just the the way that works. Rajib, why don't we talk about something that we both will probably have experienced in the past, which is that sometimes we both get the same insight. And we both are trying for the same kind of strategies, the same kind of trade. And for the time being, let's assume our latencies are identical. What happens in those cases?
So there is, you get market data from the exchange, you process the market data, assume both of our servers are similar, and then we send out orders to the exchange. Now there is a lot of variability when you send orders to the exchange, because you don't send orders to the exchange matching engine directly. You send it to the gateway in between. Then the gateway determines which exchange matching engine it should go to. Okay, so one very quick question. So how many instruments do you think are listed on the various Indian exchanges on a daily basis? So what do you think is the number of financial instruments listed on NSE, BSE, MCX on a daily basis?
Or traded, or actively traded. You can choose any one answer.
Sorry? 30,000. That's a good number for actively traded. So just one exchange alone, the number of instruments listed is to the tune of around 100,000. I think it's a little less than that. I would be surprised if it has already reached 180,000. So just one exchange, and the answer. Yeah. So combining all exchanges, probably 180,000 is a good number. So the thing is, when you send orders to the exchange has to have a matching engine to match your orders, your buy orders, but versus someone else's sell orders, right? So that is called a matching engine. So now the exchange would have multiple matching engines. Now you would log in once, and then therefore your login goes to a gateway. The gateway has to figure out which matching engine it should send the order to. So you said, I want to buy in Reliance. Yeah, the order has to be sent to the Reliance gateway. You said, I want to buy in SBI. It has to be sent to the SBI gateway. Now, the thing is, if there is a lot of activity in Reliance at that point of time, and then you are trying to send an order in SBI, and then someone has you are unfortunately connected to the wrong gateway. So therefore, then your orders would get choked up and so on. So you would get slightly worse quality of service compared to someone else who is connected to a slower, faster gateway. So basically, if our latencies are same, then it depends on how you model the gateway latency. But I personally feel that, for example, a lot of work these days goes towards reducing the latency of your trading strategies. So it's like I run a lot. I ran like 7 long distance races in 7 weekends recently. But I have to like prepare a lot for every race because I'm not a good runner. I see the winners technically, means they just wear normal clothes and then they have like, they just go and run and then not even the best of shoes and so on, right? So while I'm focused on trying to reduce every second by optimizing my, my dresses and so on, on the other hand, there are others who are focusing on their skills and so on. So likewise, so Michael Phelps won 23 gold medals. He doesn't shave his body to reduce drag, but then the lesser swimmers, they shave their bodies and so on, right? So likewise, us trying to reduce nanoseconds, it helps in a way, but then there is an even bigger pool of opportunities where it comes to being able to decipher the insights from the huge amount of information. We get 1 terabyte of data per exchange on a daily basis. So if you get that much information, and then if you can use big data to find insights from it, you can do way much more.
Yeah, so I sort of agree on most of these points. On the running bit, I'm doing a 10K on Sunday, so I guess we'll see about that. But the point I think about deciphering more details from the market data is super important, right? So everything doesn't eventually lead to just a monolith sort of single sort of track race. There are various ways to get to where you need to be. And there are various ways for you to win. So if anybody tells you that, oh, you can only do algorithmic trading if you have 50 crores or 5 crores or X, Y, Z, it's nonsense. You can, if you have the skills, both from a math standpoint and from a computer science standpoint, you can join firms like ours who will give you the opportunity to work with an enormous amount of data. And I think, to plug both Rajiv and my company, we both are willing to take a risk on youngsters who are actually keen on working in that area. Of course, they have to demonstrate the required skill sets because, it's a cutthroat business in that sense, right? So if you do demonstrate that, there is no reason to believe that you can't join the industry. I mean, for sure you can join. And I think both of us come from reasonably, middle class backgrounds. Both of us didn't have too much money, as far as I'm aware, and so there's nothing that prevents you all from getting to that same point. Okay.
Just before moving on, so this is one very interesting point that probably some of us should be cognizant of. So basically, when we backtest strategies. So often traders say that, hey, I backtested this strategy and this is the return and profit and so on and so forth. So there are a lot of fallacies. So you need to be aware whether the strategy truly has some alpha. Alpha is the edge that the strategy truly has. Sometimes a strategy could be making money because it might have some benefit from certain market regimes. So therefore, what we do is when we build trading strategies, we try to figure out if the trading strategy so basically, what was the strategy returns on the days on which the market went up? What was the strategy return on the days on which the market went down? So if you see that your strategy has a bias which you are not aware of, likewise you look at what is the strategy return on the days on which the market had a gap up, gap down, volatility went up, volatility went down, VIX went up, VIX went down. So therefore that helps you identify biases in your strategy, and then that is one thing that I would recommend all of you to look at while building strategies. Is there an inherent bias that might exist? Yeah, sorry.
Yeah, so I think maybe we should talk a bit more about the kind of strategies that most of us end up doing, right? So one of the points that Rajiv just alluded to was, I think, more about, you could argue, when you're doing any form of arbitrage, which is essentially similar products, and you're trying to figure out a way to buy in one and sell in the other, whether it is by way of the structure of the product or by way of venue of the product or some other, whether it is, by way of the time duration of that product. So some form of statistical relationship that they both have. And in most cases, when we talk about arbitrage, we are effectively talking about some form of mean reverting strategies. Okay, so what you see over here, in some senses, is very, very similar. All four are actually very similar, yet they could not be more dissimilar in this thing, right? So the first set of things tend to be more about mean reverting strategies, right? So effectively has a lot less risk, but does have some basis risk, as in you buy one thing and sell the other, and there's a spread between them, and then that doesn't compress and instead expands because you got that relationship wrong or whatever, right? Then you have the market making side of things, which is what Rajiv was essentially referring to earlier about, bidding and about trying to compress the bid-ask spread, right? So effectively, when you compress the bid-ask spread, it's happening because you're providing liquidity on both sides. You're willing to stand on both sides and say, I'm willing to buy at 100, I'm willing to sell at 101. Come hit me on both sides. I don't care which one you're hitting me. I know how to manage my inventory, and I know how to, quote managing my inventory, right? The momentum and trend and event-driven in some senses are similar, because what you're trying to discern through, again, statistical means is, like we referred to that thing about the seller of 80,000 shares, where you're trying to discern effectively which is the direction that the market is going to take, right? And so you're trying to be in the direction of the market, right? So in some senses, the first one is about not being in the direction of the market, because you're actually saying that the spread has become 10, and so now you think that it will compress. Whereas in momentum and trend following ones, you're saying it's gone to 10, I think it'll go to 15, right? So, but intuitively, when you start researching any of these, you begin to realize that they all have components of each other in them. You cannot really do arbitrage if you do not understand what kind of market making is going to happen, and unless you understand what kind of microstructure is going to affect you, you won't be able to do any momentum-led strategies. And if you understand microstructure, you will benefit even on the arbitrage side. Event-driven in that sense is very similar to momentum, but it's more immediate and more sort of massive effect. So I think insofar as the type of strategy, maybe Rajiv, should we just take up, because of the time, should we just take up like a pair strategy, and maybe you can go through that with everybody.
Okay, cool. Just very quickly. So I'll still very quickly go through it. So what are the kind of innovations that are happening in this? So there is a lot of work that is happening these days in terms of leveraging non-structured and alternate data. So basically, people look at the number of ships that are mooring, that are parked near the harbor. So that is an indication of if they find oil prices in the future to be expensive. If they feel oil prices are going to go expensive, they will keep it parked and then rather than use it, right? So therefore, a lot of work on non-structured and alternate data that is where a lot of interesting stuff is happening these days. Okay, so next slide probably. So we're in the so trading is all about finding a lagging source of information and using it to trade on the leading source of information and using it to trade on a lagging source. That is all about trading. Find a information source which is leading, use it to trade something which is lagging. Okay? So basically, Pepsi and Coca-Cola, both of them are in the soft drink space. And then if there is no news about Pepsi or Coca-Cola in specific, if Coca-Cola prices are going up, Pepsi prices are likely to go up as well. है ना? So therefore now, or it could be the other way around. Pepsi could be leading and Coca could be following, right? So now you need to figure out if there is truly a lead-lag relationship, and if there is a lead-lag relationship, which one is leading? Does A lead B? Because if A is going up, B is going down, you need to figure out if B will follow up or A will come down, right? So you need to figure out lead lag mein who is the leader, and then number two, what is the time gap, and so on. So there are various ways of doing it. So the most, this is the most simplest one to understand, shifted cross correlation. So basically you, instead of taking correlation of returns of two time series, you shift one. You say that time t, so how is the return of this series correlated with the return of a historical time series of the other instruments. So Coca-Cola ka, the prices of Coca-Cola today versus the prices of Pepsi X seconds earlier from today. So are they correlated? If they are, then it means that there is a lead lag relationship. These are somewhat advanced concepts. So for example, the lead lag periods could differ. So instead of Pepsi always following Coca-Cola with a time gap of 1 second, Pepsi could follow Coca-Cola with a time gap of 1 second, sometimes 5 seconds, sometimes, and so on and so forth. So therefore, this helps there. And then when it comes to tick-by-tick data, because the rate of data arrival is non-synchronous, so you have to use actually advanced concepts of Hayashi, Yoshida, and so on. So basically, trading is all about finding leading information and how you could use it to trade lagging. So you need to know these concepts really well. So, okay.
So, okay, before you remove this one, over here, are there any people who've actually worked with time series data, or has anybody actually worked with any of these algorithms? You have, right, okay. So, in general, these concepts are very useful. So, one of the things that you will learn if you're in algo trading is that a lot of the concepts can be reused in multiple ways. So if you get very fixated on saying this is for this purpose, then you will limit yourself. So if you really want to get into this field and try to do well in this field, it is somewhat like saying that I will read as much as I can about most of these concepts and then selectively also apply bits and pieces of it. And so really smart traders and really smart researchers you will always find that they will do some things which are a little more intuitive, little more combination rather than just outright one thing.
And just to pique your curiosity, you see the prices of rubber in the commodity exchange. You see the price of Apollo tires in the equity exchange, that's an opportunity. You see the price of gold on MCX, you see the price of jewelry stocks on NSE, that's an opportunity. So try to figure out which one leads what. So just to pique your curiosity.
Yeah, I can give you another example, which is, I don't know if any of you track any of this news. MCX will be able to guide you if you want to go to their booth and ask them more details on this. But there's a very large copper mine in Indonesia which got shut down about 10, 12 days ago. Okay, they had an accident in the mine. So effectively, there are 3 other mines which are under maintenance or stopped for the time being, and this was a very large mine which stopped. So this was almost 2% of global copper supply. Okay, so you're roughly talking about 5 to 7% of global copper supply, which is non-existent right now. Okay, of course, some parts of it will come back over the year. This mine is probably going to take 3 years to come back, at least, if not 5. Okay, a new copper mine takes between 5 to 7 years for any mine to become operational. There's been no new mine which has become operational in the last 5 to 7 years itself. There's been no new start in the last 5 to 7 years. So given the amount of EVs that we are beginning to see and the amount of copper requirement, if you can guess, you're going to get to a point where suddenly copper is going to become a very actively traded metal. Okay, so while it may not have any major algo thing that you can figure out right now, but it certainly should, for anybody who's keen and wants to grow from where they are, it's something that they should track, because over the next 5-10 years of your life, copper is going to be a very important thing to trade. Now, you have to figure out how do you want to trade it and how are we going to benefit from it. Now, it doesn't mean that the prices are going up. I'm not making a recommendation for the price. I'm just saying that it certainly means that there is going to be enormous volatility around that, right?
Next slide. So you've been in this industry. How is your risk framework? How do you ensure that, because you are relying on independent teams, right?
Yeah.
How do you ensure that nothing blows up? And then you can stand here and speak having the confidence that things will work out fine in the background.
Yeah, I mean, markets, we trade multiple markets, and I haven't received any risk alert from my team, so we are doing all right, I guess. The reality is that you can be the most brilliant researcher, you can be the most brilliant trader on planet Earth, and you will blow up if you are not careful and if you don't have risk management in place, because you will get it wrong at some point. Okay, there's no mechanism by which you don't get it wrong at some point or the other. So if you have no framework which guides you, then you're really in trouble, right? So, and most of the framework for risk lies in mathematics again. You do not need to, make decisions which are emotional. There are times you're going to lose money. There are going to be large sums of money in relation to what you may have, but you will have to live through it to make more money, right? So one of the criteria, and this is something that we could potentially talk about, is that we use there's a concept called the Kelly's criteria, right? And I'm sure between the two of us, we use this enormously because it effectively tells us what should be our bet sizes, right? So a lot of the things that you do in algo trading, a lot of the analogies actually come from gambling. And in some senses, it's very good it comes from gambling because gambling has a bad name and all of that, right? And so if you can really understand the mathematics behind that gambling, you begin to understand why a casino always makes money, right? And so you want to be that casino. You want to be the one who's willing to lose once in a while, but is going to make most of the money in the long run, right? And so for us, the risk management piece is probably the most important thing. So I can assure you, if any of you went to any reasonably large firm and said, I have this brilliant trade, and the team looks at it, says, yeah, this is a brilliant trade, but if you get this wrong, you're going to lose 10% of the company's capital. Most of us are going to say no. I know I'm going to say no, so don't come to me with that trade. I don't know about Rajib, but I don't think even he will accept that, right? But the broad point I'm trying to make is when we think of algorithmic strategies, we think about risk the most. Operational and counterparty risks are a little easier to handle because they're more things that are in your control. You're not dependent on other parties to manage this. There are ways and means to make sure that you have, good sort of, I like to call it good hygiene, because if you start off by having a bad sort of integrity, a bad process, you will fail on both of these 2 points, right? Both on our operational and counterparty risk and on the regulatory risks. So when you start out, you've got to make sure that your brain is set in the direction of saying, I want to do the right things, because that really defines what's going to happen in those. I don't want to get into too many details because there are too many variables here, but the basic point is whether it is counterparty risk, external risk, they are all somewhat in your control, but typically in your control if you've done all the right things. If you've not followed the law, if you've not done what you're supposed to do, then you are going to get into trouble in those. The market and liquidity risks are very, very real, and there are some things that we cannot emphasize enough. Liquidity risks that we are referring to is somewhat addressed by something like Kelly's criteria, which is to say, supposing I'm going long Tata Steel and I'm buying 10 crores worth of Tata Steel. am I going to be able to sell 10 crores worth of Tata Steel? Even if I got everything right, my algo was correct, my direction was correct, my momentum was fantastic, but still does not work.
Do a Q&A. We just have 5 minutes.
Okay. Oh, so while I'm told that we are into the Q&A space, but then feel free
You're free to keep saying whenever you want to.
Yeah. Yes, go on.
Talking about the regulatory risk, I mean, can you put your view about the latest regulatory circular which has came for algo trading? What does it mean for retail, institute, and also for brokers, and where this is going?
Do you want to take this?
Okay. So basically, the market likes good news. Market is okay with good news, bad news. The market is not okay with uncertainty. Likewise, for retail, a lot of retail was trading algorithmically, but then they had, it was a gray zone, right? So I think it's great that there is a prescribed set of rules. It's still in initial stages because our team means we have another business, Quant Insti, and then we have a broking business as well, right? So we are trying to offer those services, and then therefore we have a lot of questions, gaps in those understanding, and then we are trying to figure out the answers to those. But it's good that we are at least on the right path, because till now, till like a year back, algo trading for retail was we were operating without any regulations. So at least we have started the regulations, which is the best thing. So and with time, all the gaps will be filled, I think. So
Yeah, I agree. I think in general, clarity is far better. Why do you want to have any ambiguity in whether you're doing the right things or not, right? So that's why I said, where regulatory risk is concerned, the problem is, did you do the right thing or didn't do the right thing at the beginning? And if you don't know what is the right thing, then how do you know you did the right thing, right? So it's very good in some senses. Whether taking away of the weekly options or something, I think, see, some of this, and this is partly for all of you to address too, right? Because, and for any of you, since all of you have ChatGPT and you have Google, you should all look up and say what happened to the Korean markets in 2016 and or 2014, 16, that range of time period. And you'll see a striking similarity to India. And that's very worrying because their volume went for a toss, right? And it's not recovered, even today, right? So the question is not, I don't think we are in the same space. Our regulators have sort of walked a sort of better line than the way it was done in Korea. But these are things that, you over a period of time, you also have to sort of think about and address. And the more you write and talk about it, the better it is.
So basically, what Sanjay was referring to was the regulations for the index options
Yes.
and so on, right? So yeah, so in that zone itself, so markets have to be balanced. So different products, means you cannot have lopsided liquidity. And then as a economy, you need liquidity in far longer dated instruments way more. Means that is where the true hedgers, the value participants hedge, right? So the recent initiatives to spread the liquidity into the underlying and then not have them lopsided so that there are arbitrages and so on, so that people couldn't manipulate the markets, I'm totally in favor of it.
Yeah. So, since we were already warned about our timing, maybe what might work is, you had a question? Yeah.
Yeah, about that time series data, right? So sometimes what happens is when you build a time series of a longer time, right, that gets inbuilt in your model, but then there are some outliers happening for 1 year or 2 years, right? So in that case, do you suggest to change the model itself, or is there any other remedy to it?
So, maybe I'll first try to understand it a little bit more. You're referring to where, let's say there is a time series of 100 data points, and out of these, in the middle somewhere, there's about 20 data points which are somewhat anomalies. So one easy way that we sort of try to work around this is to try to equalize time, right? So can you equalize time and say for a per unit period of time, and this is not necessarily the answer that you might get from Rajiv. Everybody will try various different ways of doing this, right? So for per unit of time, what was the delta between the two ticks or two periods of moves, and then try to see whether the model still works. So in general, you must remember one thing. If a model has to work, if you have too many anomalies and you're not being able to capture them, or you're trying to sort of average them out, then you're not going to get very good answers. So it's like saying, if the price is 100 and suddenly you got 106 and it stayed there for, let's say, 2 minutes, then went back to 101 and then stayed there for 35 minutes, the average is going to be about 102. But that doesn't tell you anything, right? Because what happened to that 106? So per unit of time typically is a very good metric that we use. Rajiv can.
So the way we look at it is there are regime shifts, and then different models work in different regimes. So often 1% of the time the market is very different from the rest 99%, and this 1% is the most profitable often. So that is the time of highest volatility, highest activity, right? So now, but then your models have to change. You cannot say that, okay, this was the mathematical relationship, this was the relationship between instruments A, B, C, this is how prices move. So let me trade the same way in the extreme 1%. So often, a lot of our strategies, what we do is we try to actually find out those top 1 percentile data points, and then try to fit a model for that, because that is more profitable. Instead of trying to fit for the 99 percentile when the market is calm and quiet and then there is a lot of competition. So aiming for the one, that is one way in which we do. And then ideally you would want to trade the entire 100%. So regime A, model 1, regime B, model 2. So regime identification. Yeah.
There's a concept called jump diffusion, and you should read about that, because it tells you how to think of a model change when you have a jump in basically the whatever you're dealing with, right? So it's a very interesting concept, and it really works. Of course, you have to think about how that change has to be effected, because how do you identify that there is a jump happening at that point of time, right? So
we have one last question.
Okay. So, at the current juncture, do you think algos would be profitable or make sense for the currency and bond markets in India? What's your take on that?
Oh, so currency, unfortunately, it was a favorite market of mine. So I personally used to trade a lot. So RBI has said that if you are not a hedger,
Futures regulation, right?
it came last year. So if you are not, if you don't have an exposure, then you cannot trade currencies on the exchanges. So which has killed the liquidity, and then which has impacted people's ability to hedge. I think that's my personal viewpoint. So you can't do algo trading because you only have exposure in one direction. If at all you have an exposure, and then you can hedge that. So you can have some TWAP, VWAP algorithm to trade it out, but then the liquidity on the exchanges is okay. So your question is, can you use algo trading in segments where liquidity is?
Yeah, like bonds where RBI presence is heavy, and currency. Both.
How would you trade bonds in India? Mostly? So basically OTC, right? So the problem with the OTC is that in general, I would think that, and Rajiv can bear me out, we both will tend to operate more in liquid spaces and listed spaces. Trading OTC is not a problem, but the problem is, do you have a fair market that you can trade? So one of the problems with the FX now, with the currency market, is exactly that, right? It can't be a fair market for traders like us, right? Because the problem is that supposing you have an exposure, and so you're trying to hedge, who can buy your exposure? I mean, logically, who can be your counterparty? That would imply that there is an importer who has to sell, who has to buy your exposure, right?
Basically, it's a problem of transferring the risk, right?
Exactly. So basically, the market is a mechanism. It's a transmission mechanism, right? So that transmission mechanism is not working. And with the more illiquid it becomes, the more problematic it becomes.
So you do have the interest rate futures on the exchanges, but then look at the number of participants, the type of participants, the volume of trades that happen. theoretically, you can do algo trading on interest rate futures on the exchange, but means that would require a different set of algos. And you might be competing against, if the market is very heavily populated with people who are the fundamental traders on that exchange, then you might not have as much of an edge. So I personally avoid interest rate futures, for example, at this moment.
So I think just to close, maybe Rajiv, you can talk about anything interesting that you see, whether in technology or something really interesting about what you see as the future. I want to end with an anecdote after you finish. So,
okay. So basically, the markets are becoming very interlinked and connected. So the prices at one exchange. So for example, we talked about how gold versus say jewelry stocks and so on, right? So now the volumes on the Indian commodity exchanges are increasing and so on. So now there are innovations in terms of transferring information across exchanges really fast. So basically nowadays people, what they do is instead of like sending information through optical fiber cables, people used to send through microwave towers, one tower shooting to another, second to third. People say that this is also too slow. So now what they do is they shoot information from a data center near the exchange to the ionosphere. It reflects from the ionosphere. So from Chicago, they shoot into the ionosphere. They capture it in Iceland. From Iceland, they again shoot into the ionosphere, capture it in Europe, and then so on. So there, you can only send not even bytes, 5 bits of information every 50 milliseconds. So things of that sort. So people are working in those directions. So being able to make the world a connected place. Number two, in a lot of sphere, we are approaching the limit of physics, be it in terms of transferring information from one place to another. New York to Chicago, for example, is 3 point something millisecond, and then speed of light is just a few hundred microseconds less than that. That's it. So we are very close to the limit of physics when it comes to computational, because you cannot do more computation because the gap between transistors is now close to the width of an atom. So you cannot increase computational power and so on, right? So now I think the way things are progressing is in being able to get insights from huge amount of information. It's not about being faster anymore, or whether transferring information. There's a lot of work towards making it faster, but we are approaching the limits of physics. Yeah. A lot of work towards reducing computation, but then approaching limits of physics. Yeah, sorry.
Yeah, I think this will remain a perpetual question, and this has been asked of the last 20 years. I think that are we hitting the point of race to zero, and have we hit zero or not? I think we are, like Rajiv is pointing out, that you cannot beat physics. So we are approaching the limits of physics itself, right? So there's going to be a lot more innovation around discerning more information from data rather than only speed. So yeah, and I think I just want to end with, going back to that murder mystery anecdote. And so, and I'm not too sure of how real this story is. So, I mean, you don't fact check it, but it sounded like such a cool story that I wanted to say this, right? So in the 70s, all the American spies in Russia would get caught. And can you, all of you, guess as to why that would be the case? They would not, it came out much later as to why that was the case. Because when those fake passports would be made for the American spies, they would use stainless steel staples. And the passports in Russia did not use stainless steel staples, and so they would rust. And so when the American spies would get caught in Russia, it would be because the staples on their passports would not rust. The reason I tell you this story is because discerning information from market data is actually very, very similar. It's very cool when you start putting it in these terms, because if you can bring your brain to think like this, that how do you catch that spy? And in some senses, that 80,000 order is in effect an American spy, and you're the Russians, you're trying to catch that. You're going to try to figure out, how do you figure out whether his passport has got those rust stains, right? And if you can figure that out, you're going to make a lot of money. So that's about it, I think, from us. And
Thanks a lot.
thank you all for being here. And,
Thank you for the wonderful example.
Well,
just so that all of you know, actually, he is the one who created the PPT and everything. I was just the hanger-on. So.
Wow. Give them a big round of applause, ladies and gentlemen.